IFRS 11, joint arrangement. A joint arrangement is when two or more parties, be it individuals or entities, have joint control to an arrangement. Okay, so the characteristics of joint arrangement will be that the parties are bound by a contractual arrangement, and secondly, the contractual arrangement offers the party joint control to the arrangement. Let's look at some terminologies regarding joint arrangement. The first is the term arrangement. This is a business setting, and we all know what a business is. The second terminology we'll be looking at is control. So as determined in IFRS 3 business combination, control is usually defined as the power to influence the financial and operating policies of a business or an arrangement to derive some benefit from the person who yields the control or holds the control. We move on to joint control. So this is where the sharing of control over an arrangement is based on a contractual agreement that strictly requires unanimous consent of all the parties for relevant activities to be undertaken. So if, for example, there are 5 parties to an arrangement and one disagrees for a part to be chartered, that quest stands aborted. Now, party to a joint arrangement. So any entity or individual that has joint control to an arrangement will be a party, meaning that their consent must be sought for in times of critical decision making pertaining to the arrangement. Investor to a joint arrangement. So any entity or individual that participates in the agreement but does not have joint control, meaning it invests resources but their consent is not necessarily required for decision making in relevant areas of the arrangement. Last but not the least, we have special purpose vehicle. So this is a structure separately distinct from the parties, established for the purposes of executing the activities of the arrangement. It can be legal or not. We look at the types of joint arrangement we have. There are 2. The first is joint operation and the second is joint venture. We'll first look at joint operation. Here, any agreement that does not have the presence of a special purpose vehicle is automatically a joint operation. Secondly, there might be the existence of a special purpose vehicle, but it must not be registered. Okay, so it's operating similarly to a sole proprietorship type of business, where the owners are liable for the losses or the debt of the enterprise. Thirdly, parties have rights to their contributed assets and obligation to its associated liabilities to the arrangement. It means that when somebody contributes a vehicle to a joint operation, the business does not have control over it. He can recoup the benefit out of it and take it as and when they deem fit. Fourthly, parties have right to revenue and obligation to the corresponding expenditure. So any revenue that is earned from the use of the asset that they have contributed, they stand to benefit fully from it. So is any expenditure that is accrued. Okay. Then lastly, parties to this type of arrangements are called joint operators. So the accounting treatment for a joint operation is that the joint operators recognizes in its financial statement 1. the assets that they have contributed, including those that they jointly own with other party or parties. And secondly, any attributed liabilities, including those that are jointly held with another party or parties, so the asset that they have contributed, in case it becomes a liability or any liability that is accrued to their side, they have to record that portion in their separate financial statement. Thirdly, their share of revenue from the sale of output realized will also be recorded in their individual financial statement. Fourthly, any related expenditures to the process of earning the revenue in the third point will also be recorded individually. Then lastly, any investor in a joint operation will recognize its interest as the joint operator would in its separate financial statement. We move on to look at the second type of joint arrangement, which is the joint venture. So here, there's a notion that an institution has been formed and it owns all the assets that has been contributed and all the liabilities that has been accrued. So whatever that comes out of it is what the parties owe. It's not that they contribute an asset and they have right to the asset. All revenue and expenditure coming to it is what they draw from. Secondly, it might be an arrangement structured through a special purpose vehicle, but here it must be registered and legally distinct. Then lastly, parties here are called joint ventures. Let's look at the accounting treatment. A joint venture must recognize in its separate financial statements its interest in the joint venture as an investment in arrangement. Now, this will be recorded in the non-current assets section of the statement of financial position. Therefore, they would have to use the equity method, which is the IAS 28, investment in associates and joint ventures.